And now, David, perhaps we'd like to hear from you about a little bit more about the clean technology opportunities. Thank you.
Good afternoon. Thank you for coming by. My name is David Kurzman, and I am Senior Vice President with Panel Intelligence here in New York City. First of all, you'll notice whenever Peter talks, I take a lot of notes. It's kind of like school is in session. If you ever get a chance to hear Peter speak, if you get a chance to download some of his books, do it. He's one of the brighter minds in this space. Surprisingly, you'll notice we have a lot of the similar ideas, and yet we did not collaborate on our talks. So let's understand a little bit about this clean tech opportunity, and let me provide you a little bit of background as well on myself. I have 12 years on Wall Street, 6 of which were in the clean tech sector, actually 7 now. Going back in January 2nd, 2000, I was hired to start the alternative energy and industrial technology, before clean tech as a term was coined, for H.C. Wainwright and Company. Then I worked for Needham and Company for a couple of years, running their clean technology research group, and then launched my own clean technology hedge fund, which I ran for about 4 years before joining Panel Intelligence. The problem here is that I only have 20 minutes, not 2 hours, because that's what this topic really deserves. And this is another problem, that we still look for other opportunities as a way to make money in clean tech. Hopefully everyone can see that. I'll read the caption. This is our most successful project, pointing to the wind turbine. When we dug the footing for the wind turbine, we struck oil. Here's another problem that we have. The wind turbine has other unappreciated issues. A lot of folks say it kills birds or it destroys your skyline. So let's just back up for 1 second and define what clean tech is. It's any technology or service that reduces humans' impact on the environment. Now, this covers, as Peter really pointed out, a plethora of areas. Peter really focused mostly on that center column, what I'll call the alternative energy sector. But really, it's a small piece of a whole bunch of larger industrial sectors. It's flow control, filtration technologies, catalysts, manufacturing industrial processes, agriculture, and nutrition. The idea here is to really try to understand clean tech. You've got to be an expert, a little bit of an expert in a whole bunch of different things. Well, how big is this? It is enormous by any definition. And this is just a handful of some of the subsectors, where we were in 2000 versus where we expect to be in 2015. The problem is, again, how do you deploy large amounts of capital into an area that is so young and at the same time is very, very early stage? I'll get a little bit more into that. And it's growing at astronomical rates. What is the trend? And Peter began to address this. Does this group have staying power? I believe it does, but let's just take a look at some of the facts. Back in the 1970s and 80s, we had what was largely a regulatory-driven market. There's nothing inherently wrong with that if it's done right. As Peter said, if the policy has teeth. We had compliance-based purchasing and end-of-pipe technologies, such as scrubbers and other filtration technologies on our coal-fired power plants. We had relatively slow growth markets, as well as some what should be phrased as questionably sustainable fringe businesses, like solar, where the economics were not yet there and there sure wasn't the policy behind it. We also had a plethora of inexperienced managers. But where are we today, knowing where we came from in our history? Well, science really has caught up with awareness. The bleeding heart liberals, they were right. They were right, but we just didn't have the science ready to really address the problem. Global warming, our pollution issues really do have an economic cost. So we have now these economic market drivers as well as a growing awareness, not only here in the US, we're always the last to learn. We were the last with seatbelts, we were the last with anti-lock brakes. I mean, it's no great surprise to me that we're going to be last to the party in clean tech. Furthermore, on the economic drivers, this is also a part of understanding where some of the regulatory opportunities are. We have a real focus on trying to maximize profitability, because if you think efficiency and productivity will go out of style, then you really shouldn't be thinking about clean tech, because they never go out of style. No business person in his or her right mind wakes up and says, you know, I think I want to make less money today. They want to make their business more efficient each and every day. The process technologies, trying to reach zero-emission plants. Again, that feeds right back into the profit maximizing and efficiency question. You have incredibly fast-growing billion-dollar markets, as I've already suggested, as well as what Peter has termed, that was actually his term that I stole from him, corporate green screens. He took it from one perspective. Well, the investments banks have green screen. Well, so does Walmart. So do a lot of different retail and commercial businesses. And there are now whole new business models that didn't exist, like demand response. I will pay you every quarter if you agree to shut down your business for several hours when peak power demands are causing instability on our electrical grid. That business model did not exist in its current form 10 years ago. Furthermore, and this is perhaps the most important thing, we have an incredible pool of talent that is being attracted to this group. When a business manager gets acquired by Philips, says, thank you, I'm going to take my golden parachute, and then goes and starts up another company, and he sold the business for over $1 billion, he doesn't have to work anymore. Why does he go and do that, continue doing this? It might be for, to feel good about himself. Maybe it's because his children are going to be inheriting the environment that we leave them. But the bottom line is they're all attracted to these different bullet points right above. So if you're going to come away with one sense here, it's definitely going to be to watch where the money flows. And Peter's right. The certainty in the financial markets, long-term certainty, is what drives the financial opportunities. So the first inning is over. It's kind of funny that you termed it that way, Peter, because really that's all we've gotten through so far. We've invested cumulatively over $15 billion into clean tech just since 1999, roughly 10 years. And that is only a drop in the bucket of what's needed. We have billions and billions that private equity and venture capital still need to put to work. And they don't get paid if it doesn't get put to work. So where is that money gone? Well, Peter's right to focus on alternative energy because almost half of it has gone to energy-related opportunities. The next big one is, looks like their environmental IT and what's considered enabling technologies. Transport and logistics, that can include the fact that FedEx and UPS now, they count how many times they have to turn left, because every left turn means that they have to then idle and cross traffic. And that costs them not only time and fuel, but eventually money at the end. So understand what you're watching. This is going to be key to understanding how to identify these market trends. For instance, where has this money gone from a financial perspective? What does that teach you? Because a lot of this money can be put to work in big chunks in project finance. But is that necessarily where Main Street or Wall Street or foreign investors want to put their money? Well, the bottom line is private equity for projects, project finance, the yellow bars here, is where the large magnitude of money has gone, while this private equity for companies, by its very nature, is going to be much bigger than venture capital, but has received a surprising amount of money. Fortunately or unfortunately, a lot of money back in the first half of this decade, and very true in 2006 and 2007, went into pipes, private investments in public entities, which basically means that we were funding a bunch of public companies at private equity valuations. So policies and regulations. Well, today's New York Times has an article, and I've clipped a section of it, that we're taking a look at trying to extend the investment tax credit, the ITC. So follow the money. It's a very timely subject. If Senator Cantwell from Washington has her way, she's going to extend the ITC, which is a $6 billion 10-year proposal, to make sure that renewable technologies have the funding. If that doesn't get renewed, those projects are very likely to die on the vine. I happen to think it's not a if, but a when, but I'll get to that. So I don't have eyes that can read that either, so don't worry. The idea here, the point of this slide is this is just the current legislation in our 110th Congress of what to be watching. You can go to bradleywoods.com. This is all available for free on the web. Education really is going to increase this opportunity. And so there are a lot of different things you can be watching. I know I can't watch every single one of these, but these are all in Congress, and I'm sure I probably missed one or two. So you got to understand, as my father has always said, where you've come from to make sure you don't repeat your history. So I highly recommend that we recognize that 2 years ago, we were dealing with what I called public venture capital. So in other words, these were companies that really had no business being public, and yet there they were receiving large amounts of capital, largely due to the fact that there was more excitement than there was substance. So at that time, I recommended that Cleantech managers use that opportunity to increase their coffers, AKA call your banker. Since then, valuations have moderated largely across the sector pretty well. A year and a half ago, they finally did moderate, and they did call their bankers, but not before a lot of companies had their IPOs and their merger and acquisition transactions. And I put a couple examples up here: Veriston, Aventine Terrace, North Island Green Energy, et cetera. The point is that with that capital, they can now execute on their business plan. So what is the lesson? Follow the smart money. Because if they're running for the door, take note. You might want to do the same. A year ago, I said that investments in the renewable space were experiencing what I called an incentives-led boom. So solar and ethanol investments were where you wanted to be. And that largely played out as expected. I also said at that time you should begin to watch for the end of the silicon shortage sometime in 2008. I was actually thinking it would be the second half of this year, but it's now over. In fact, it was at your conference, Peter, several weeks ago that I first came out and I said, it is over. We're starting to see cancellations of orders. When a company says, wow, I don't like the fact that my silicon supplier in China is dumping the old chemicals into the rivers that are killing people downstream, so we're going to cancel our order with that polysilicon supplier, that's a sign, because I guarantee you, if there were still a shortage, there would have been no mention. They would have taken that polysilicon left, right, and center at any price. So 6 months ago, I was talking about how hydrogen as a fuel was beginning to become the hot topic again. Well, here's the problem. Hydrogen is an industrial gas. It's not a fuel. It's not a panacea for our problems with fossil fuels or global warming. It is a very well understood commodity. Furthermore, hydrogen from renewable sources, have your solar panel or your wind turbine to generate your hydrogen either through electrolysis or some other way, that is a niche opportunity at best. Again, not a panacea. Where folks should be looking 6 months ago, and I think this is true again today, is in battery technology, specifically on the cathode and the separator. There's some work going on in tin anodes, but the bottom line is it's inside the battery, not the battery itself, the packaging and so forth, where the magic is. I also said 6 months ago that the corporations were employing a green screen, which gave a lot of vendors and suppliers an opportunity to benefit. Furthermore, carbon capture and sequestration of carbon dioxide was going to be potentially one of the biggest opportunities as part of the clean tech market that we've ever experienced. But it would be best addressed by financial markets and certain select technologies. But this is going to take a long time to develop. So where are we today, and what should we be looking for in the future? Again, I think the renewal of the ITC, the investment tax credit for renewable technologies, is a when, not an if. And the reason is this is an election year. Politicians love to look green, so they're going to posture and they're going to look as green as they can. And they're going to probably wait till right up before the election. The Earth Day is going to come and go on, what is it, April 22nd. Maybe somebody will try to get something passed. It won't. Very likely is that we're going to see this sometime in the second half of this year. Furthermore, the rebound in solar stocks is currently underway. It's not over yet. So look for the biggest and the cheapest among those, and also look for the companies that have catalysts. So they might have a subsidiary that they need to IPO. So the drivers here are, if you are if you are a photovoltaic manufacturer, or solar manufacturer, the end of the silicon shortage means your highest cost raw material is about to decline in price. That means your margins are likely to expand. Likely renewal of the investment tax credit, another driver. Earnings and revenue increases. This is an industry that's growing 30–40% top line revenue per year. And estimates are probably going to have to go up. IPOs of subsidiaries, and as well as further expansion of state renewable portfolio standards. In other words, states such as New York have mandated that by 2020 or some other arbitrary date, way down the road, a set amount of our electricity has to come from renewable sources. There are problems with these laws. For instance, what if they have no teeth? Where's the compliance issue? What if we don't meet it? Who gets punished and how much? But the idea here is that that will serve, at least in investors' minds, as a catalyst. Again, always follow the money. Watch for the exits by the smart money, because that'll be a sign that the end is near. With the silicon shortage over, prepayments on the decline, and plant construction, we just saw, I believe it was STP, or no, it was Trina Solar, just canceled a $1 billion polysilicon plant that they were going to construct. They canceled that earlier this week. So then the question comes, is a bust cycle following the boom cycle likely to happen? And I think it probably is. So this could be a big boon for photovoltaic manufacturers' margins. The path to sub $1 per watt production costs on solar cells is very clear. We're almost there. In fact, cadmium telluride photovoltaics are probably going to be the first one there, very likely followed by copper indium gallium diselenide, or CIGS for short, technology. Probably. And the reason I say probably is because there are some technology hurdles that need to be overcome. Companies with the greatest growth margins, profit margins, are going to be the most likely to win. But don't overpay for growth, because eventually that whole industry will commoditize. Hybrid electric vehicles and plug-in hybrid electrics, opportunity is enormous, but it is very, very difficult because there are so few public investments to play in that area. So you have to be very selective, look to private companies, look to valuation, and again, watch for the exits. Ethanol, to quote the teenagers, is so last year. Now it's an asset play for the private buyers. They're going to go out and say, well, in the public markets, we're not going to get the valuation we want, so it'd be better to have the cash flow. So they'll buy the plants. Carbon could arguably become bigger than oil and natural gas combined. The carbon markets and related technologies are potentially the largest opportunity within all of clean tech, and they're best addressed by the financial markets, as well as certain select technologies like carbon capture and sequestration. This could take decades to implement, though. And the reason is, even after public policy is created, even after we have our election, even after our new president selects his or her first 100 or 1,000 appointments that have to be Senate confirmed, we still then have to give corporations enough lead time to prepare their business models and adjust. So this could take a long time to put into place. And again, another problem here, very few ways for Main Street to play in this space so far, but that's likely to change. I do think mercury abatement and related technologies, and there are some public companies in this space, if you do a Google search for activated carbon, companies, and mercury, you'll see a whole bunch of different companies that you can invest into this space. And activated carbon is the cheapest way to get mercury, almost all of it, about 90–95% of the mercury out. It's much better that we get it out in the activated carbon than to have it in the fish that, and water that you and I consume. Our water and electrical infrastructure, Peter said it, it's grossly underinvested, and regulations are tightening. So emergence of whole new business models like demand response and the constant need for clean water and sustainable electricity are the way to go. Meanwhile, capital continues to pour into VC and private equity funds. They have to put that money to work to get their 1 or 2% and to earn the 20% upside that they earn. They're competing against hedge funds for ideas. That's a real problem, and I can speak to that. Having run a hedge fund, I made 6 private equity and venture capital investments. Now, I was fortunate. All of them worked out or broke even. But a lot of the hedge funds out there are grossly overpaying because they don't understand what they're dealing with here. So that flow of capital and those public market valuations that they're going to put on private companies are only going to eventually be pushed back into the public market, and multiples will expand into the stratosphere. Follow the smart money. I can't say it enough. The smart money today is investing in solar, mercury, gasification technology. So instead of combusting coal, you basically gasify it. You boil it. You gasify waste. And the good side of that is it's potentially lower pollution and a lot more efficient. Digestion technologies. You take organic matter, you can anaerobically or aerobically digest it and create natural gas and fertilizer, as well as big investments in infrastructure. And by the way, in the infrastructure area, I think there's going to be a whole new market created in infrastructure-related bonds and project finance bonds. And the idea there is the folks who are lending the money are going to want to securitize those. It's a very well understood business model. Then turn around and sell those securitized cash flow streams to other investors like hedge funds. A lot safer to be than subprime these days. Thank you very much.